we're going to be focusing on equities because, let's face it, it's a meaningful allocation in most portfolios, and FY19 was pretty tough for active management. There's also a lot of factors to consider in terms of volatility of equity markets and how we think about portfolio construction. So it's a great opportunity to hear from our panel today. But before I introduce them, I'm going to start with our polling question, which will come up if you select Forum A in the app, Federation Ballroom. Do you regard recent volatility in equity markets as a portfolio construction opportunity to increase equities, build up cash, reduce equities, hold steady no changes, or introduce downside risk protection overlays? So while everybody's voting, I'm really excited to have three very different perspectives on the panel today. We have Leigh Gavin, Chief Investment Officer of LUCRF Super, representing trustees and obviously asset owners. We also have Catherine Allfrey, who's a Principal and Portfolio Manager for WaveStone Capital, focused on Australian equities. And we have Clare Armstrong, who's a Senior Investment Specialist at Fidante, who has a very broad experience in manager selection. So three different views for today. So just looking at the polling results, they're coming up. Take off my glasses so I can see. Interesting. So introducing downside risk protection and overlays seems to be the winner, pretty closely followed by hold steady, no changes. And I think this is a pretty tough question to answer with a multiple choice because obviously, you know, some funds are trimming, some funds are sort of topping up their equities on dips, and we have seen some funds building up cash over time. So very interested to perhaps chat later about downside risk protection and overlays. So we've got a busy session today, so I think we'll get started with Leigh Gavin to hear from the asset owner perspective. Thank you.
Thanks, Karla, and thanks for AIST for having me today. So as Karla mentioned, last financial year was a pretty tough year for active management, certainly in Aussie equities and for many funds for global equities as well. So in a space of about 50 minutes, we're trying to cover equities, domestic and global, only 55% of most funds' portfolios. So I'll just try and cover a few things that keep us awake at night as asset owners, or at least this asset owner. And particularly in relation to the equities portfolio. This is even before we get on to Trump tweets, tariffs, trade wars, test match cricket, and that twat Boris Johnson. Couldn't think of any other T words. So there's a few things keeping this CIO awake at night at least, and certainly the one most obvious that has probably come up at a lot of investment committee meetings over the last few weeks is what the heck happened last financial year in our market. And then we'll roll into the global equity market and what's been happening there. There's some common themes between the two. So Aussie equities, so the chart here and what a difference 1 year makes. If you just think about the rolling 10-year performance of active Australian equities managers, there's all different universes and different surveys. This is from eVestment, and the universe is helpfully trimmed by our helpful consultant. But the rolling 10-year performance of the median Australian equity manager has fallen from 2.2% before fees to 1.3% before fees over a rolling 10-year period. The bottom quartile has fallen to 0.3% per annum before fees. So depending on what fees you're paying, it's a really horrible result or a really, really horrible result. But the upper quartile manager has still generated 2.8% per annum over a decade. It's still certainly worth having. And we'll talk more about the last year and what the importance of active management if you can get it right. But clearly last year was very unprecedented. And Clare and Catherine are going to talk a little bit more about some of those themes over the next few minutes. But clearly our experience was we shared in that unprecedented theme over the last year. And it wasn't just fund managers having a tough year. Super funds also had a tough year. This is just the Super Ratings SR50 Australian Shares Index. I've just picked out a few industry funds here. I probably haven't picked out all the industry funds in the room. It's obviously a busy chart. I'm told that the slides will be available on the app later tonight, and let's be honest, you'll just want to try and find your fund on there, and hopefully I've got the numbers right if it's your fund, or Super Ratings have got it right. But we've said for years that asset allocation is the only thing that matters, and you've probably heard at conferences that asset allocation, it's all about asset allocation, explains 90% of the return, 90% of the risk. The gap between the top and bottom performing Aussie shares options, which is usually a pretty good proxy for the Aussie shares portfolio, not always, but usually, was about 7% from top to bottom last year. So on about a quarter of the portfolio, it's nearly 2% total fund impact between top and bottom. And the really curious thing about last year was, some really, really good super funds with really good Aussie equity portfolios. So the number 50th for the last year was the number one over the last 10 years, and is still the number one over the last 10 years. So it wasn't like good managers forgot how to pick stocks, and it wasn't like good super funds forgot how to pick good managers. So there's some really specific themes to draw out over the last year. So we had an investment committee about 3 or 4 weeks ago, and it went something like this. So with 6 investment committee members asking something like this, along with Patrick Stewart's character Captain Picard in Star Trek, and Timon from The Lion King. The only reason I know that's Timon is that's the last goddamn Ushi we had to get from Woolworths for the kids. But I'm pretty sure I wouldn't be the only CIO who had to confront similar questions from their investment committee along these lines over the last few weeks. So what happened, or WTF happened, over the last 12 months? The one thing to say is, yes, the last 12 months was unprecedented in terms of underperformance from Australian equities managers as a universe. There's certainly some that did well and some that did certainly less well. As a universe, it does tend to mean revert. So it tends to bounce off these sort of years, and nearly 3% underperformance from the median manager is almost unprecedented, or is unprecedented, certainly. But it does tend to mean revert as companies start to revert towards fundamentals. And the 2 classic cases when median manager underperformance was at this extent was just before the GFC, 2007, and just before the tech wreck in 99. The one thing that is interesting, so that's the orange line in this chart. The blue line is the outperformance of the A-REIT index versus the All Ords index. There is a strange negative correlation between A-REITs and the performance of active Australian equity managers. So what was a key theme of underperformance last year from our managers? Apart from all being underweight Telstra that outperformed 60%, delivered a 60% return last year that no one saw coming, and almost everyone was underweight. Almost all were underweight the A-REIT index, which is only about 8% of our index. But if you're 8% underweight that index that outperformed by 8%, there's about 64 basis points of underperformance there. But even that's not enough to explain it. So it's a broader theme, and it's the broader theme of those nasty bond proxies. So a lot has changed, and I think we need to be fair to managers. A year ago today, the Aussie 10-year bond yield was 2.57%. Today, it's about 0.89%. A year ago, we were talking about whether the RBA could hike rates with a slowing housing market, how long the Fed would keep hiking for, and how many interest rate hikes they had. A year ago, we were talking about other central banks hiking rates. Today, we're talking about cutting rates again, 0 lower bounds. At what point does the RBA introduce unconventional monetary policy? So, admittedly, this hasn't just happened overnight. And Guy Debelle, who's one of the senior economists at the RBA, did do a speech in December 2018 where he said, "Quantitative easing is a policy option in Australia should it be required. There are less government bonds here, which may make QE more effective." Now, Millie was talking about the GFC and 10 years on and what we might do in the next GFC. Philip Lowe echoed some of those sentiments at his appearance at the House of Reps Committee into Economics a couple of weeks ago. Globally, if all central banks go to zero, then we'd have to consider that as well. We are prepared to do unconventional things if the circumstances warranted it. If circumstances warranted it, we could take action to lower the risk-free rate further out along the time spectrum, i.e. lower yields at the longer end of the curve, like 10-year bond yields. So we know that QE works because we've seen this movie all around the world, and it all goes to what Ben Bernanke introduced in that famous Jackson Hole speech in 2010 of the portfolio balance channel. So with that in mind, what looks cheap? Well, not a lot really. But these stocks have performed extraordinarily well. Charter Hall, Goodman Group, Transurban, Sydney Airport, all bond proxies, all that you would expect to perform well. And these stocks are by no means cheap. Sydney Airport trades on a PE ratio of around 44 times today. So we can certainly understand why our managers wouldn't want to own it. Transurban trades on a PE ratio of about 27 times. But at some point those stocks were cheap, and at some point those stocks will be cheap again. And just beware the face palm emoji, which is something I didn't used to use, but I used it a lot with my wife. Like I've just dropped the kids off at school, but our 7-year-old is wearing a size 4 t-shirt that looks like a crop top. So, what looks cheap? Well, not a lot really. Clearly, we've talked about this in the US for years. The only time that US PE ratios were this expensive was 1929, 1999 and 2007. None of those three worked out particularly well for investors. Australia is not there yet, but approaching one standard deviation expensive. All those things are supposed to matter, and they will matter one day. But as Jared talked about this morning, Sir John Templeton's famous quote that the four most expensive words are, "This time is different," certainly holds true. Unfortunately, Sir John passed away in 2008. If he was to come back today and look at Swiss 10-year bonds at -1%, the German government issued a 30-year bond a couple of weeks ago with a 0 coupon for 30 years, he may perhaps say, dude, this time's a little bit different. So Aussie equities, on that measure, look somewhat cheap if we look at equity risk premiums. And there's a variety of ways to compare equity risk premium, though I can't do justice today. But a very simple measure is simply the earnings yield, which is the inverse of the PE ratio, minus the bond yield. That is as wide as it's been since 2013 and 2009. Both points were not a great time to be short Australian equities, as we know with the benefit of hindsight. So just touching on a couple of quick themes in the US, one of the big things that are concerning us is, yes, there's a lot of private equity activity, and yes, there's a lot of IPOs. They all have one thing in common though, they're not making a lot of money. So The Economist ran an article a few months ago about unicorns and tech unicorns. A unicorn is a private equity tech business with a value of more than $1 billion, which we all used to think was impossible. There's 315 unicorns today compared with 131 in 2015. So they're deeply discounting their services, whether it be rideshare or whether it be shared office, through what they call in Silicon Valley blitzscaling, where basically they try and obliterate all opposition in a winners-takes-all strategy. Now that's fine if the winner does take all, but can Uber and Lyft and Didi all take all? So there's a lot of things that are different about the late 90s. At least these companies do have revenues, but there is an increasing number of them who are IPOing without profits, and the last time this happened was 99, and we all know how that ended. Likewise, in the Russell 3000 index, which is the US large cap, mid cap and small cap index, about 25% of companies are making a loss. If you think about that, the US economy from a corporate perspective has almost never been stronger. Not so much from a worker's perspective, but the share of capital versus labour, the cost of debt, GDP growth, unemployment, for 25% of companies to be making a loss through that entire index when the economy has been so good is somewhat concerning. And then very lastly, value versus growth could be an entire session, but we know that the last 10 years has been unprecedented in terms of the outperformance of growth versus value, given value had outperformed growth for most of the last 300 years. It's been extraordinary, as you can see on the chart on the right, and it should mean revert at some point. The triggers for that mean reversion are not obvious, and the reasons for that underperformance are obvious. It's not surprising that the winners of technological disruption have mainly been in the growth camp, and the losers have mainly been in the value camp. So Waiting for Godot was a play that I studied in high school, and some others probably did, written by Samuel Beckett. That's Patrick Stewart on the right, and that's Ian McKellen on the left, not a value manager who can't afford shoes, or not yet at least. There is some parallels with the underperformance of value and that Waiting for Godot scene. It should mean revert, but not necessarily, and not necessarily today, and not necessarily tomorrow. So with that gloomy note, I'll hand over to Catherine.
Thanks very much, Leigh. And I just wanted to remind you to submit your questions through the AXA IM app. It'd be great to get your questions through. And now I'll pass back over to Catherine. Thank you.
Thanks very much. Well, I'm not here to defend the indefensible. We also underperformed in the last 12 months to June, but we were underperformed by about 1% for the FY19 year, and we did a lot of soul searching as to why that was the case. And one of the things, like Leigh touched on, is that what we didn't predict was the great sort of stock market bond disconnect. We didn't expect this time last year that we'd see the unprecedented bond rally, particularly here in Australia. So whilst we did have some bond proxy stocks in our fund, we weren't overweight those stocks. Clearly also the other stocks that have been absolutely skyrocketed to unprecedented valuations is the technology sector, and I've just been through the reporting season, so I'm going to give you some highlights and lowlights of what's happened in the Australian stock market and what the Australian corporates are telling us about the outlook for Australian equities. But first up, in terms of this stock bond disconnect, this is obviously getting a lot of chatter here at the conference, but also I can tell you in terms of talking to both the stockbroking community, but also all the global economists, everyone is talking about what has happened and why the Australian stock market and the US stock market in particular keep performing well. And I think, fundamentally, once Powell did that pivot in January, the stock market thinks that the central banks have got their back. Now, the disquiet, I guess, that the chatter in investment circles now is as this trade war continues to roll on, and in the first quarter of 2018, global trade was growing at about 15% year on year. It's now gone negative. And what we're seeing is the slowing down globally. Obviously, it started in Europe, it spread into China, Japan, and now we're starting to see it in the US as well in terms of the last few months as the economic data has deteriorated. And clearly, when we saw those tweets by Trump not last Friday night, the Friday night before, so about 10 days ago, that was a shock to the equity markets to wake up and have another look at what is actually going on in terms of this trade war and the impact it could have. The interesting thing from a stock market perspective is the US consumer up until now has held up, and that's been what's holding up, I guess, the global economy. And so the question now is, as the tariffs roll on, and the first tariffs to hit really the US consumer are this month. So it's the impact of what happens to that US consumer as to whether or not global equity markets hold up, whether this downturn becomes a recession, and what the central banks do about it. Will there be some sort of global intervention? In terms of the impact of rates, and obviously what I've talked about in terms of the last 12 months, and that amazing rally that we've seen, you can see in the key bond proxy sectors of infrastructure, real estate and telecommunications just how the compression in those yield stocks have happened. Now, the main reason for this is, as Leigh was touching on, in terms of what is the impact of the Reserve Bank cutting interest rates and what is the impact on the stock market. Well, as you can see, what's happened is there's been the compression in yields in those bond proxy sectors. Prior to the GFC, what would happen is you'd have these rate cuts and then we'd see the economically sensitive stocks react to those interest rate cuts. So we'd have an increase in small cap stocks, value stocks and cyclical stocks. But post-GFC, investors have lost faith in a low growth environment that is what's going to happen. And so instead, everyone's been seeking income in the market as interest rates collapse. The other interesting thing here is in terms of banks. You can see over 20 years here that actually the yield on the banks has increased. Now, the main reason for that is in the last 4 years, we've seen a 15% decline in banks' earnings here in Australia, and we all know the reasons in terms of remediation, restructuring, the actual whole Royal Commission impact, but also the cash rate impact, and that's what the market is really worried about with bank yields at the moment. As the cash rates are cut, that has a direct impact on banks' margins and, of course, earnings. So that clearly will impact the dividend. Overall, the ASX 300 industrials, you can see there, has compressed in terms of yield from 4.2% to 3.2%. So in the last month, we've seen a lot of Australian corporates for one-on-one meetings, and we've constantly been asking them, what does 1% cash rate mean to you? And most of the management teams that we've met with, the CEOs and CFOs, they're really cautious, right? Because what they're looking at the moment is a revenue line that month on month is getting worse, right? And it's because if you particularly got any links to the global economy, like a Sydney airport, they're seeing it in their passenger numbers. So most companies have kept an eye on that revenue line, and now they've almost got a playbook where they're looking at cutting costs, and then they've got the bottom drawer playbook of what they're going to do if it really does get bad, both here in Australia but also globally. You can see also, look at the interest rate, the net debt, to EBITDA interest cover for the banks, for the companies as well. We're at 1.3 times for the median ASX 200 company. So that's just unprecedented in terms of how low it is. And in a low rate world, you expect to be doing more. But most companies, when we asked them the question, they basically said, strategy stays the same. If we can, we'll try and squeeze the banks and get a lower rate on that interest rate, which will help drive their earnings overall. But most companies are very cautious about the outlook. Look, the positives for the Australian economy and Australian equities are really the clear fact that we've had 2 interest rate cuts. We don't have negative rates, so we've still got room to move. And obviously the market's expecting at least another 2 rate cuts here. We've had tax cuts, and the good thing with the budget going into balance this year means that the government can do more on fiscal policy, and we would expect them to do more. And obviously there's a lot of discussion at the moment as to whether they should be doing more earlier. But the good news is they can do more. The other positive thing is in terms of public infrastructure, particularly in New South Wales and Victoria, this constant recycling of capital and this driving of infrastructure is actually keeping the economy bubbling along, particularly on the building sector when we are seeing a housing construction downturn. And that clearly impacted a number of companies, and they provided actually a lot of the profit warnings. Boral, for example, Adelaide Brighton, they had very poor numbers and profit warnings coming through. The other positive is the service side. So service exports have been growing at 9% per annum. But like everything, all roads lead to China. So education is up 15%, and also the leisure travel with 1.5 million Chinese coming to Australia now. But unfortunately, one of the interesting trends from the reporting season was that the Chinese student numbers coming here are actually only up 2% year on year now. So there has been a real drop-off in that growth rate of Chinese students coming to Australia. Positively, the population growth, we're the 5th largest growth rate in the world, so currently growing at sort of 1.6% per annum. So that's also holding up the economy. So we do have some positives here. I don't want to be all negative about the outlook. So this is actually the earnings outlook and the numbers as they stand. So pretty disappointingly, for FY19, the companies have come in with 2% growth, and it has been negative earnings revisions, both for those 19 numbers, but also for the 20 numbers as well. You can see really what saved it in the FY19 year was the resources sector, and that was because iron ore prices doubled this calendar year. They peaked in July at $122 and obviously have rapidly come off to about $87 today. But that really drove those big three miners, and you can see as a result they've delivered very, very strong growth. You can also see internationally, with the Aussie dollar falling, the support that that has given international industrial companies. And overall, whilst it's only a 2% for the market growth rate, really held down by the banks being down 7% as well. There were 60 companies in the ASX 200 who recorded double-digit growth, which actually is a positive sign, but there were 90 companies that had negative growth. The best performing sectors were healthcare particularly led by CSL and ResMed, absolutely brilliant results, and the stock prices responded accordingly. And also the REITs was the only other positive revision that we saw for another sector. Every other sector was pretty flat or down overall. So I don't want to be particularly negative about the overall outlook, but let's keep watching the ping pong between Xi and Trump, and let's hope that the downturn doesn't lead to a global recession, because clearly equities will be in trouble if that does occur. We're cautious near term, but we are very positive long term, and we're going to keep watching that Twitter account. Thanks very much.
Okay, in this last part of the discussion about equities, I want to sort of pivot a little bit. We're going to change the tone of the discussion, turn the mirror onto the investment management industry itself, and specifically equity managers. So equity managers are amongst the most self-confident individuals I've ever met. I've spent 25 years examining them at a fairly close vantage point. And whilst I think this statement from Charles Darwin will be quite threatening to some of them, it is quite true that the best investment minds are not necessarily the best business minds. They're not necessarily the worst, but there's no guarantee. So it's been a very tough year, not only for equity markets, but also for managers. When I arrived here this morning, I came with the understanding or the belief that about 19 firms had closed down in the course of this year. Extraordinary. And in a coffee break, I was told it was 20. So my commiserations if the 20th manager is one of you. We'll have a drink this afternoon to talk about what the industry holds. But I think the idea that the business environment is a tough one is very timely. I think the issue of rationalisation, though, is very important. And I think that the idea that managers have been enjoying the super margins that the industry has provided for such a long time, and perhaps haven't been as proactive in managing their businesses in a fashion to cope with the threats that they face is coming home to roost. So in terms of the closures that have occurred, really no one factor has been the key issue that has spelt the end for some of these businesses, but rather a convergence of a number of factors or a multitude of those. And these are things that perhaps are affected ultimately by weak performance, but are the result of a number of decisions that the business has made over the course of its operating life. So, these are things like the decisions that are made about the ownership structure, the alignment model, the product mix, the investment that a business makes in its distribution force, the pricing matrix, and their client mix. And I really don't think that luck has really played any part in the demise of many firms. And for every one of those internal factors, of course, though, there are these significant and powerful externalities that are now spelling not the end, but spelling, perhaps a little change in the landscape for active managers. Shifting investor preferences, margin compression we've spoken about many, many times at events like these, regulatory developments and complexity is increasing and advancing technology. So the message I want to give you though is that asset owners and consultants, I would urge you to focus on understanding at this point in time these very important cultural issues, the issues that the managers themselves can control. How are they dealing with these internal forces to better protect them against these externalities, which are proving to be quite powerful. So I'm sure many of you would agree with me about the destructive influence of the Schadenfreude in popular press. I myself used to have to comment on the performance of active managers every month to the press and try to come up with a positive message about why the active industry was not in peril on the back of its 1 month returns. I think this short-termism is extremely negative, and the idea that the median manager is the manager upon which we must all be reporting is a bit of a fallacy, I think, and is very damaging. I mean, the median is a measure of the central tendency, but when a vast universe of managers are clustered around the benchmark return, the central tendency is not going to be very interesting. So I would urge you not to assess the quality of the peer group by the median manager, and that's why we'll have a look at what the best performing managers have done. And Leigh, I thank you for softening the waters for me in this regard. This is a chart from my old shop. I'm just channeling some saying about old dogs and new tricks, but I'll put it to the side. This is a chart that shows you how the active universe of managers has performed in rising and falling markets. So the bold line there is the top quartile of managers, and this is a 3-year chart, and anyone who has a 1-year investment horizon really shouldn't be investing in equities at all. So I've put the 3-year chart up to encourage you to consider more broadly a longer term investment horizon, and I think this is a really good story. Look at how well Australian equity managers have performed, or the best performing Australian equity managers have performed in weaker markets. Precisely the time when they should be protecting investors' assets, they have delivered not 1 quarter of negative return from the top performing manager. And in fact, the median manager, which is the dashed line in the middle, is also never had a negative return on a rolling 3-year basis. So these reports of the demise of active management are vastly overstated. That's the Australian equity universe. What about the global equity universe? Actually, still a pretty good story. The level of outperformance is not as high as the active Australian universe, but it's still quite impressive. And the global equity managers have probably done a bit of a better job over the last quarter, which has been tough for Aussie managers in particular, as Leigh and Kath have told us. So this is 140 managers. So there's plenty of room for rationalisation in both these universes. But one thing I also want to say about these universes is that not every manager wants to participate in the universe surveys because of this issue of short-termism and the publicity associated with having to comment and having your name published in the newspaper. Many businesses consider themselves, powerful and strong enough to stand aside in that sort of discussion. And I can think of 6 managers that used to be, that were back in my day, very highly rated, who declined to be involved in surveys. So don't be misled by the popular press and its obsession with the short-term performance of active managers. In actual fact, they're doing a pretty good job. But let's talk about some of these threats that they're facing. Market saturation and a lack of differentiation, I think, is a very big problem. Many managers just do not have a strong sense of their competitive edge. And I think it's these managers that are finding the environment very challenging. I think the next session is talking about consolidation. It's a very prevalent issue for the industry. Bigger, fewer clients increases business risk for managers that are capacity constrained. So if you're a manager and you're full and you sit on the panel of these ever-growing industry funds and asset owners and they consolidate, you cannot extend further assets to them, which makes you an increasingly smaller part, increasingly smaller. An ever smaller part of a much bigger pie to the ultimate end that even your excellent returns cannot move the dial for that asset owner, that platform. So that is a very big risk, even for very successful managers. Internalisation's a different challenge, and internal teams at asset owners do compete with external managers, there's no question. Once again though, as the assets grow, if managers are unable to allocate further capacity to the strategy, then the influence of the internal team just continues to grow at the expense of the active group. The persistent shift to passive and rising interest in factor investment approaches I really think of as the kind of love child of active and passive. So they're sort of a passive approach which is actively applied. I think they provide extraordinary challenge to CIOs like Leigh in terms of the timing of factor exposures and the selection of indices that will be tracked by these factor portfolios. So that's a whole nother challenge, I think, probably not that much easier than actively selecting a panel of active managers. So I think that's to be honest, a false economy. And back in the day, we used to think about those factor portfolios as perhaps providing a new benchmark for the assessment of the success of active managers, and that's probably the extent to which I think they're very valid. Rising regulatory and operational costs are just a part of doing business, aren't they? And Leigh spoke about the incredible dislocation that's apparent now in value versus growth. But the message I want to leave you with is that the entrepreneurial spirit of investment managers is very much alive. Since I joined my new firm, we have had more than perhaps 200 meetings with individuals and teams who want to set up new businesses. So even though existing firms are perhaps struggling with the challenges of the new marketplace, there's a very ready army, if you like, of confident individuals who believe that they can continue to add value. So please be reassured that there's plenty of new strategies, hopefully with some eye on the landscape and the changing landscape and what asset owners need in their portfolios, such as protection strategies, as our quiz revealed, to provide the continuing challenge to the CIOs in relation to their selection. What do you think about passive versus active? Do you want to go there?
Sure.
Maybe not. Just to leave you with one interesting statistic. In April this year, the volume of assets that were in the US market invested passively for the first time exceeded that which were invested actively. So this is the statistics back 10 years ago, or no, 20 years ago now. And this is the statistic today, April 2019. So I expect that we'll continue to see the switch to passive investing, but I don't think it's necessarily the result of the disappointment in active management, but rather some of those other issues that we discussed, fee compression, etc. And I think we might leave it there. Brilliant.
Thank you.
Thanks, mate.
So thank you very much to all of our speakers. We have had a couple of questions come through on the app, some of which I think Clare has covered off. So I might jump to one question. Should the super funds' internal teams of managing equities have Chinese walls to their manager selection team? So that might be something for Leigh to think about.
Yes.
Kath, I think you'd agree.
Totally, absolutely.
Does our panel agree? Okay, great. Is there any questions from the audience? Free to jump in.
I mean, just on that, if I can also give an answer. I mean, one thing we hear when we're talking to asset owners about the way their panel of active managers interacts with their internal teams and the value that the active management panel brings to the table, even as their percentage of assets across the total portfolio diminishes relatively, it's the market, it's the insights that they bring. So even if their influence in terms of returns was diminishing, the value of their insights is very important to the asset owner. So I think that's part of their very important part of their value proposition, even going forward.
Sure. A question over here. Microphone's coming up.
Thank you. Anne O'Donnell, MTAA. Just that last comment you made about now in the US there's more passive, or there's more money in passive than in active. I'm a very simple-minded person, but it does seem to me that with that shift, there'll be a point where it'll actually become an advantage to be an active manager rather than part of the pack. When does that point happen, do you think? Oh, well, is that right? And what's your prognosis on that?
Well, I do agree that that's right, and certainly one of the advantages that talented active managers offer in defence of their existence is that the shift to passive investment does provide opportunities. And I think we've seen a couple of examples, where the purchasing of stocks, income-related stocks, for example, or stocks that are following certain, volatility characteristics, are bid up unnecessarily or inappropriately, and become an opportunity for active managers to exploit.
Yeah. Well, for example, with the resources sector being so cyclical, if there's a large part of the market in terms of index terms that starts underperforming as an active manager, you can obviously, have zero exposure to that sector, or you can have half exposure to that sector. And then clearly you saw that in 2015. There was a big outperformance of active managers in that year because most of us were underweight the resources sector. So we outperformed versus the index managers. So when there's a large sector that underperforms over a period of time, you find that active managers can take advantage of that.
Great. I might see if there's any other questions from the audience. If not, I'll go to the iPad. Yeah. Here we go.
Thanks, Karla. It's Brendan Casey from Rest. Besides the fact that we Australians are just clever, I'd be interested in the panel's views as to why Australian managers historically have delivered greater alpha than overseas equities managers. For the Australian market, of course, I'm talking about.
Do you want me to answer that?
You go.
Yes, please.
I think it's got to do with the concentration too in terms of the index weightings, like I was just saying, which obviously you're nodding to, because clearly the bank sector makes up 20%, the resources sector 15%. So as active managers, yes, we can take sector bets against those big indexes and outperform as a result.
Yeah, and we clearly have a weird market here, not as weird as Finland in the latter days of Nokia, but we have a very concentrated market, as Catherine mentioned, and that's one of the reasons you don't want to be 100% passive in Australian equities if you can avoid it. I think we were heavily underweight the banks during the Royal Commission last year, and obviously every day a NAB or Westpac or CBA executive was in front of the Royal Commission, we were going, yes, on multiple levels, the least of which being that we were 10% underweight the banks. So, yeah.
Great. Any other questions from the audience? Great.
Hi, it's Yolanda Beattie. Clare, I wanted to get you to probe a little bit further on some of those cultural challenges you mentioned caused the implosion of some fund managers. What do you see, and what are the type of questions you ask that raises the alarm bells?
Well, that I used to ask. Yeah. So questions about succession planning, alignment, the composition of teams, the way that the investment decisions are made, the extent to which the investment processes or decision makers are challenged within the decision-making process, all very important. The recruitment processes, all very important decisions about the culture. We've had businesses that have 10-year equity plans or 10-year payouts for developing team members, and which sort of creates a whole different level of alignment than you might typically observe. So it's just a very broad range of different issues affecting that culturally.
Thank you. So I might just wrap up with a last question to the panel. We've talked about a lot of the reasons why managers didn't perform as well as we would expect over the past financial year. Do you think that active managers will perform well in the coming financial year, or will there be a meaningful switch to passive strategies? A final thought from our panel members, please.
You start, Claire.
Well, I think the answer is hopefully. I haven't got my crystal ball in my handbag today, but I certainly get up each day with the expectation that active managers are capable and able to outperform over the longer term. I can't talk about the next year, but I can certainly say that I believe that active managers are still very relevant in portfolios.
Yes, I would hope so, in terms of speaking about all my brethren. But yes, we're very confident about the next 12 months.
12 months is a tricky time period to crystal ball, as you should remember, Karla. But
Going off the app.
The biggest issue is these bond proxies. You can make a case that Sydney Airport on 49 times earnings is very expensive. It does throw off a 4.5% dividend yield. Transurban throws off about a 4.5% dividend yield, even though it's trading at nearly 30 times earnings. You can make a case that we could be here in a year's time talking about a 3% dividend yield on these stocks, because for a German who just bought a 30-year bond with zero coupon, or a Swiss who just bought a 10-year bond that gives them negative 1% per annum for 10 years, they don't look so bad. And if that continues, this will all return to normality at some point. But in the interim, things might get a little bit weirder. And if the weirder things get, I think the tougher it'll be for active managers everywhere, not just Australia.
Fantastic. So I'd like to thank the audience for their participation, and sorry we didn't get to answer your questions through the app. And importantly, thank you very much to our panellists, Leigh, Catherine and Clare.